Hello and welcome to a brand new episode of ET Market Smart Talk, a show where we engage with top experts to provide complete insights into current market trends and their impact on stocks and sector as well. My name is Shubham Anand, and today we have a very special guest, Chirag Goshi, CIO of Fixed Income at LGT Wealth India. Welcome to the show, Chirag.
Hi, Kshitij. Thank you for having me here.
Thank you so much for taking the time out, Chirag. And let's quickly, understand the impact of the India's sovereign rating upgrade that happened. Yes, it was quite a surprise, last weekend, but we've been upgraded from triple B minus to triple D. And how could it impact the yields on government securities in the short term, medium term?
Right, Kshitij, two things are visible already. First, the immediate action or reaction from the market side was a dip in the government bond yields as
Sure.
the markets priced in a lower sovereign risk premium after the upgrade happened by
Mm,
S&P and which moved India to triple B from triple B minus on August 14th.
right.
The 10-year yield softened by roughly 7 basis points around the
Mm,
announcement, though they have retraced back now, but which reflects improved confidence and the prospect of a deeper foreign
mm,
participation that you may see in India.
right.
That is for short term, but in the medium term, the upgrade alongside the ongoing index inclusion that is already there should
Mm,
anchor the term premia lower, and
okay.
this also is subject to the fiscal glide path staying credible from the government side.
Absolutely. And could this rating upgrade lead to a re-rating of Indian corporate bonds? And if so, which segment or sectors, or if you want to probably stick to the corporate bond market on that?
Sure, absolutely. I think a sovereign upgrade typically relaxes the sovereign cap for high quality issuers. We've
Sure.
already seen S&P has upgraded 10 financial institutions, including
Mm,
SBI and HDFC Bank, post the upgrade. So right
right.
after the sovereign action, we have seen that these upgrades have come. The
Mm,
immediate beneficiaries are, in my view, banks, top tier NBFCs, and quasi sovereigns in the infrastructure financing space, where spread should compress fastest as offshore and onshore investors will start reassessing the risk. More broadly, I think the IG corporates or the investment grade bonds with robust balance sheets should see lower
mm,
funding costs and better
mm,
secondary market liquidity with this.
right. And what specific factors are creating special opportunities in the bond markets right now, Chirag?
So I see a confluence rating upgrade plus index flows. So the
Okay.
S&P move coincides with the India's phased JP Morgan emerging market bond inclusion and
Mm,
Bloomberg's emerging market local inclusion for the FAR bonds. So
okay.
structural drivers of steady foreign demand for government bonds, that combination supports price resilience, I think, and lowers the hurdle
Uh-huh.
for duration for bond markets in India.
Mm,
Plus the GST reform impulse, right? We heard
yes.
Prime Minister signaled a review and rationalization of the GST, and the
Right.
government is proposing cuts towards a two-rate structure, which could be 5 and
Mm,
18%.
yep.
Markets have already responded positively. The
Oh, yes.
consumption
Yeah.
boost can lift corporate earnings and improve the
Uh,
credit metrics in majority of the sectors, basically consumer durables,
mm,
financials, which can create value in high grade
mm,
corporate bonds, where the access to the bond markets will be easy and at a cheaper cost for them because of this impulse. And
yeah.
some macro tailwinds, I guess, inflation
Mm,
just printed at an 8-year low in July, and RBI has already begun their easing cycle. We have already seen 100 basis points of cut delivered by
yeah.
them, a supportive backdrop for fixed income. And I think if
Okay.
deflation persists and growth holds,
Mm,
then there is
mm,
further room for the policy support,
mm,
which will happen from RBI side,
mm,
which again will reward the bond markets in India and, of course,
right.
duration. And the
Mm,
corporate bond yields have risen more than GSEC when
ah,
the talk of the lowering of GST has happened because it may impact fiscal. But I think if government manages to maintain that, we will see that these credit spreads in AAA, AA bonds will also start
mm,
compressing.
absolutely. And how are you positioning duration in the current interest rate environment?
I'm balanced but constructive. I think at the core, I want to hold longer dated government bonds, not very
Okay.
far longer dated, but on the belly
Mm.
of the curve, which will capture the potential for price gains if the easing cycle extends, which in my
Right.
view should, complemented by a short to medium term investment grade corporate bonds for
Okay.
carry and lower volatility.
Mm.
So with the 10-year oscillating between 635 to 645 zone,
Sure.
I believe that the this exposure will benefit the curve when it bull steepens. And without over concentrating risk at one point of the curve, I think the corporate bonds will help the portfolio or the investments have a greater carry.
Okay. And what about strategy, Chirag? Are you favoring a bubble kind of a strategy, a bullet strategy, or a more neutral approach to sort of manage the duration risk?
Kshitij, I'm leaning towards a barbell kind of a strategy right now.
Okay.
Short
Mm.
end for liquidity and carry, and long
Okay.
end for duration or convexity,
Mm.
especially when policy is on a hold after a cut. And
Yes.
global easing chatter is also building now with the
Uh-huh.
Federal Reserve likely to cut rates in September. So a
Mm.
pure bullet risks missing either the carry at the front and the convexity at the back. So a barbell lets you harvest both and rebalance quickly as data evolves. So if there is something wrong with the view, we can be nimble and quickly rechange allocations.
Absolutely, a bubble strategy. That's what you're following. But you did talk about the rate cuts at this point in time. But let's get your perspective as to do you see a rate cut in the next 12 months, and how is that shaping your bond portfolio as
Sure. So our base case is 25 to 50 basis points of additional easing over the
well? Okay.
next 1 year,
Mm.
which is of course contingent on inflation normalizing and the external backdrop staying manageable, which in my view
Right.
should evolve in the way.
Mm.
Economics are now expecting the RBI to hold the near term after the June cut, with
Yeah.
another reduction in the rates later this year, which is
Mm.
possible.
Sure.
That view justifies keeping meaningful duration via the medium to
Mm.
longer end G-Secs and selectively extending in the higher grade corporates while avoiding excessive curve risk.
Okay. Absolutely. And also from a larger perspective, Chirag, how does sort of global central banks' action influence Indian bond yields and investor sentiment in the short to medium term perspective as well?
See, I think they affect in two ways. I think rates and risk appetite.
Uh-huh.
Markets are pricing in a Fed cut in September, while the ECB is pausing after a year of easing. So, if the
Right.
Fed starts to ease, the global term premia should compress, and emerging market flows, including the coming into India, should strengthen. So, which will help our yields.
Mm.
Conversely, any hawkish surprise or tariff driven volatility can tighten the global financial conditions and briefly cheapen risk assets. So
Okay.
that and energy matters too, right? Brent has softened
Mm.
into the mid 60s, which is a
Mm.
tailwind for India's inflation and current account. So overall,
Right.
India's upgrade and reform momentum makes us relatively more resilient within the emerging market basket.
Absolutely. More resilient in the emerging market basket. Well, on that note, thank you so much for your time, Chirag. And that's all for now, but do stay log on to ET Markets live stream for more investment and trading ideas. Again, thank you so much for your time, Chirag, for giving us the perspective.
Thank you, Sitij. Pleasure talking to you.
Thank you.
Should I log off?